The fear and greed index is sitting at 11, not 50, not 30, 11. The last time sentiment was this crushed, this broken, this completely hollowed out, the people who kept their composure and held their position made life-changing returns in the 12 months that followed. Now, I know what you're feeling right now. You've watched XRP shed over 70% from its highs. You're watching Bitcoin crack levels it hasn't touched in over a year. And every time you open your phone, somebody is telling you it's over. Crypto's a scam. The cycle is dead. You should have sold. Here's what nobody is telling you. Extreme fear in financial markets is not a warning sign for the informed investor. It is a signal. And right now, that signal is flashing louder than it has at any point in the last 12 months. Before you do anything, before you sell, before you panic, before you make a decision based on how bad this feels, you need to understand what is actually happening, because price action and market reality are two very different things. And today, I am going to show you the difference. Welcome back. This channel exists for one reason: to give you the clear, rational, data-grounded analysis that the noise is designed to drown out. No panic, no cheerleading, just structure, history, and logic. Today we are going deep on the fear itself, what it means, what the historical record actually says, what the geopolitical situation really signals for this market, and where XRP specifically stands in the middle of all of it. Let's get into it. Let's start with the hard truth. Most retail investors are built to fail in this market, not because they're unintelligent, not because they lack information, but because the human brain is wired to interpret pain as danger. And in financial markets, pain and danger are not the same thing. In fact, in markets, the most dangerous moments tend to feel the safest, and the moments that feel the most terrifying are often the moments that are closest to a generational entry point. Look at what's actually happening right now. The fear and greed index has been sitting between 5 and 12 for multiple weeks. This is the same range it occupied just before the 2020 COVID crash recovery, just before the 2022 FTX bottom. These are not moments people remember as disasters. These are moments people look back on and say, that was the buying opportunity of a decade. And they remember, painfully, that they didn't act because it felt too uncertain. Now let me give you the data that puts this fear in context. Bitcoin is currently down approximately 52% from its cycle high. People are treating this like unprecedented catastrophe. But let's look at the actual chart history. In March of 2020, at the height of COVID uncertainty, Bitcoin fell over 60% in weeks, and then ran to an all-time high within months. In the summer of 2021, Bitcoin dropped 55% from peak to trough in the middle of what became one of the most explosive bull runs in crypto history. In early 2023, after the FTX collapse destroyed sentiment across the entire industry, Bitcoin was down over 75% from its 2021 peak, and within 18 months, it had set a new all-time high. A 52% drawdown is not historically abnormal for Bitcoin. It is not a death signal. It is the toll you pay to hold an asset that has outperformed every other asset class on the planet over the last decade by a factor of 10. The mechanism at work here is not structural breakdown. It is sentiment compression. The market is not broken. The market is being drained of weak hands, and the institutions are picking up what's being dropped. Here's the math that the panicking crowd is completely ignoring. Total crypto market cap is currently sitting at approximately $2.28 trillion. That is the lowest point we have seen in over 1 year. The previous all-time high for total crypto market cap was above $3.7 trillion. That means we have shed over $1.4 trillion in market value from peak. Now here's why that number is not what it appears to be. Market cap is not the same as invested capital. The majority of that lost value was never real money. It was reflexive price expansion driven by thin liquidity and speculative momentum. What we're watching now is that speculative premium being wrung out. And what gets left behind when speculative premium is removed? The base, the structural floor built by genuine adoption, institutional positioning, and fundamental utility. Now apply that lens to XRP specifically. XRP is down over 70% from its cycle high. Historically, XRP bear market drawdowns have ranged from 77% to 97% depending on the cycle. We are already approaching the upper bound of that historical range. The prior SEC lawsuit bear phase in 2020 saw a 77% peak-to-trough drop. The 2018 bear market took XRP down 95%. Each successive cycle, the bottom percentage has shrunk because the asset base grows, the institutional awareness deepens, and the number of genuine long-term holders increases. The 2024 to present drawdown is already approaching that 77% territory on XRP. The diminishing returns on downside are a structural feature of maturing asset classes. Now stack that against the current state of the XRP ecosystem. The SEC versus Ripple case. Settled. Regulatory clarity. Progressing through Congress. Spot XRP ETFs. Live, accumulating, and posting positive inflows on all but 5 days since launch. Net institutional inflow into XRP over $1.1 billion. The asset has absorbed over $1 billion in new institutional capital during one of the most pessimistic stretches in the history of crypto. That is not the behavior of a dead asset. That is the behavior of an asset being quietly accumulated by entities who have done the math and like what they see. The math is not saying this bottoms today. The math is saying the risk reward at these levels, given historical drawdown ranges and current fundamental positioning, is among the most favorable it has been in this entire cycle. This isn't a prediction, it's a ratio. While retail investors are posting about the end of crypto on social media, let's talk about what the institutional players are actually doing. Because here is the brutal reality. The smart money does not react to fear. It plans for it. The silent actors in this market, the Franklin Templetons, the Fidelities, the sovereign wealth desks, the custodial institutions building out XRP rails, they understood months ago that a sentiment compression event was a possibility. And they built their accumulation strategy around it. Think about this logically. Does a $1 trillion asset manager like Franklin Templeton purchase a spot XRP ETF, go through the legal, compliance, and custodial infrastructure build-out, launch the product, and then panic sell when the fear index hits 12? Absolutely not. These entities do not gamble. They position with multi-year horizons. Every red day for retail is, for them, a discount on assets they intend to hold for years. On-chain forensic data corroborates this. CryptoQuant and similar platforms have been tracking exchange reserve levels for XRP, and the trend over the last several months has been consistent and directional. Reserves leaving exchanges, supply draining off public order books. This is the fingerprint of quiet, systematic accumulation. Not panic, not selling, not capitulation. Accumulation. And look at what Ripple itself has been building during this period of market weakness. They acquired Hidden Road, a prime brokerage that services over 300 institutional clients. They have been actively pursuing banking licensure in multiple jurisdictions. Brad Garlinghouse has been in front of regulators, central banks, and government officials in multiple countries. The architecture being constructed around XRP right now, the legal infrastructure, the institutional access points, the on and off ramps, is not the work of a company preparing to fail. It is the work of a company preparing to scale. Here is the contrast that defines this moment. Retail is looking at a price chart and concluding that the thesis is broken. Institutions are looking at regulatory timelines, adoption curves, and supply mechanics, and they are positioning for the next phase. These two groups will reach very different outcomes. Section 6. Catalyst Timeline, 1.5 to 2 MN. Now, let's talk about what's actually on the near-term horizon, because the catalyst stack for XRP and the broader crypto market has not weakened. It has grown. The first catalyst is legislative. The Digital Asset Market Structure Act and related clarity legislation are actively moving through congressional channels. The bipartisan support for regulatory clarity has never been stronger. Once this framework is signed, the last gate that prevents pension funds, insurance portfolios, and sovereign wealth allocators from formally entering the crypto market essentially disappears. We are not years away from this. We are quarters away. The second catalyst is geopolitical. President Trump has issued a 10-day diplomatic deadline to Iran. Historically, and this is documented across every major geopolitical conflict going back to the 1960s, markets initially react to military conflict or war threat with fear and selling. But that fear creates the most acute buying windows. Every major post-war invasion or military engagement since the 1960s has been followed by a market recovery that exceeded pre-conflict levels. The pattern is documented. The phrase "buy the invasion" exists in institutional vocabulary for a reason. Fear-driven selling creates artificially compressed prices on assets with intact fundamentals. The third catalyst is the Q2 2026 window. Multiple data sources are converging on this quarter as the inflection point. Flare Network's staking targets, Bitru's supply squeeze forecast, and the confluence of regulatory milestones. We are entering that window right now. The fuse is lit. The only variable is timing. Let me make something concrete for you. XRP's total supply is fixed at 100 billion tokens. Circulating supply is approximately 55 to 57 billion. Of that, a significant portion sits in wallets that have not moved in years, long-term holders who are not selling at these levels. Exchange reserves have been trending down. Flare Network is building staking infrastructure designed to lock up billions of XRP by mid-2026. Spot ETF issuers are sourcing from OTC desks and dark pools that do not have unlimited supply. What happens when all of those forces converge simultaneously? Rising demand from institutions, shrinking available float, regulatory gates opening, and the staking layer absorbing additional supply. You get a supply-constrained asset meeting institutional scale demand in a market that was not designed to absorb that pressure at current price levels. This is not a Moonboy fantasy. This is a supply-demand imbalance that is being engineered gradually, quietly, and systematically in real time. And the people who are selling their XRP into this fear are handing their position directly to entities that will not sell it back to them at anywhere near these prices. The window to accumulate at these levels is not infinite. The sentiment will turn. It always turns. And when it turns fast. Let me address the 3 objections I know are in the comment section right now. We could still go lower. Yes, that is true. Nobody has a crystal ball, and anyone telling you they know exactly where the bottom is should not be trusted. What I am saying is not the bottom is today. What I am saying is that at current drawdown levels, 70% plus on XRP, 52% on Bitcoin, the historical risk-reward ratio strongly favors dollar-cost averaging rather than sitting on the sidelines waiting for certainty. Certainty never comes. By the time the chart looks safe, the opportunity is gone. This bear market is different. Every bear market in history has felt different to the people living through it. The FTX crash in 2022 felt like the permanent end of crypto. The SEC lawsuit against Ripple felt like the permanent end of XRP. The COVID crash felt like the permanent end of everything. And in every single case, the people who held structure, held their position, and held their composure came out the other side in a fundamentally better position than the people who capitulated at the bottom. The geopolitical situation is too uncertain. Uncertainty is the price of entry into every market that has ever generated asymmetric returns. If there was no uncertainty, there would be no opportunity. The uncertainty is not the problem. The uncertainty is the opportunity. For those who understand what they're holding and why, here's what I want to leave you with. The fear index sitting at 11 is not a sign that you made a mistake. It is a sign that you are being tested, and the test is not about your ability to analyze charts or predict price levels. The test is about your ability to distinguish between how something feels and what the data actually shows. How it feels right now. Terrible. Genuinely, authentically terrible. Anyone who tells you this doesn't feel hard is not being straight with you. Watching drawdowns of this magnitude in assets you believe in is psychologically exhausting. That is real, what the data shows. An asset class with intact fundamentals, growing institutional adoption, converging regulatory clarity, documented supply compression mechanics, and a sentiment backdrop that has historically preceded some of the most significant recoveries in the history of financial markets. You did not build your position in XRP to sell it at a fear index of 11. You built it because you understood or are starting to understand that this is a once-in-a-generation infrastructure play that is still in the early stages of institutional adoption. The people who abandon that thesis during the fear phase will watch the recovery happen without them, and they will feel that more than any drawdown they ever experienced. Stay rational, protect your position, and size your purchases in a way that lets you sleep at night, because this market rewards patience, not panic. Ask yourself this one brutal question before you make any move today. Am I making this decision based on data and structure, or am I making it because it hurts? If the answer is the latter, sit on your hands. The signal is already clear for those who are actually looking. In a market fueled by fear and noise, we thrive on data and composure. I'll see you in the next one. Comment fear is the signal below if you made it to the end. I want to know who's actually watching with intention.